Hello and welcome to a discussion on the cash flows and its corresponding effects on the financial statements. Would like to once again check how different is the cash from operation from the profit after tax, and will CFO differ with one of the capital restructuring decision, that is the buyback of shares. We know that CFO is not same as PAT because of non-cash items, because of non-operating items, and because of the working capital changes. Let us take an example to understand that. So the example has a balance sheet with a normal transactions. So we want to understand the effect of these transactions on the cash from operations, cash from financing, and cash from investment. So before we understand why is the profit after tax not same as cash from operation, let us convert these financial decisions into financial statements. So the opening balance sheet is given. So we'll pick up the transactions which are given here. So the opening cash in hand is 0, no cash. And let me increase this slightly. So 110. And so the first transaction is purchase of goods. We can see that is a purchase of goods on credit from Mr. X. So therefore 100,000 purchase goods, and the stock increases by to that extent. So stock increases by 100,000. Then sold 50% of the goods, for 150,000 for cash. So therefore sales 150,000, and entire sales is for cash. So therefore cash flow, no debtors. And whenever there is a sale, there has to be the cost of goods, and the question says it is 50% of the goods. So therefore 50% of 0.50 into 150,000, 75,000. So the stock will come down to the extent of 75,000. The next transaction is sold investments. Sold investment for cash 120,000. So sale of investment 120,000, and sale of investment is income, and the corresponding cost is 100,000. So therefore no investment at the end of the year. Then you have the collections from the old debtor 50%. So collection from the old debtors 50%, so 0.50, and collection is an inflow, not an income, but the reduction in the asset to that extent of 25,000, so it comes down. Then bad debts is a loss, and bad debt is 10% of the old debtors, so 0.10, and as a result the debtors will go down to the extent of the bad debt too. We can see the debtor position. So the debtors are 45,000 minus 22,500 and minus the bad debt, which is the debtors at the end of the year. Then payment to the old creditor 100%. Payment to the old creditors 100%. Okay, payment to the old creditors 100%. So we are making the payment to the old creditor, that is old creditor 50,000 entire payment, and the old creditor will become 0. But before the payment collection, yes, payment to the new creditor 40%. So payment to the new creditor 40%. So therefore Mr. X, we pay 40,000, and X goes down, reduces by 40,000. X goes down by 40,000. Payment to the new creditor is 40. Salary for the month. Salary for the month is 2,000, but the salary paid is 15,000. So salary for the month is 2,000. So for the year 24,000, but the salary paid is 15,000. So there will be an outstanding salary as a liability of for the balance, that is 9,000. So outstanding salary is a payment less than the expense is the outstanding salary. Then the purchase computers at the end of the year, purchase computers at the end of the year for 15,000. So computers we purchase 15,000 and no expense on the computer, but the computer will appear as an asset, no depreciation, because you purchase at the end of the year. Then repaid 30% of the loan on 31st March, repaid 30% of the loan on 30th March. So therefore loan repayment is 30%, so 0.30, 30%, and is a reduction of liability. So reduction of liability, but since it has been paid at the end of the year, you have to charge interest fully for the year. So 50,000 into 1.2 interest, and we pay the interest fully in that year. So therefore interest is calculated on the original loan and interest is paid fully, so no outstanding interest for the no outstanding liability for interest. Okay, so remove. Then we have the depreciation on plant 20% and depreciation on furniture 25%, both SLM. So depreciation on the plant on the original cost 20%, so 0.20, and depreciation on furniture 0.25, and both these depreciations are non-cash flows. So therefore depreciation will be added to the accumulated depreciation respectively to the plant and furniture. So accumulated depreciation increases. No change in the plant, no change in the furniture, because no sale or a purchase of furniture. However, it is given that there is a fair value of the plant at the end of the year is 28,000. That means this process is called impairment test. The impairment test is where the book value of the asset, the book value of the plant 50,000 minus accumulated depreciation is compared with the market value of the plant. So there is an impairment loss of 2,000 will be shown in the income statement. An impairment loss will also reduce the value of the asset to that extent. So impairment loss is shown in the income statement and the asset is reduced. Impairment test is comparing the book value of the asset with the fair value of the asset. In the same way, the market value of the investment is given, but that has no meaning now because the investment has already been sold. So therefore that is not very relevant information for this. Since all the informations have been taken care, we'll sum up the cash flows, we'll sum up the income. So sum of the incomes and the expenses, incomes and expenses. So the profit before tax is 270 minus 226, that is 43,500, and we assume the tax to be 30%, and we assume that the tax is paid immediately. So as a result, the profit after tax is 30,450. If no information given, we retain the entire profit after tax on the balance sheet. Cash flows, inflows, total cash available 292, total cash payment 154. So therefore cash in hand is inflow minus the outflow. 138,000 is an asset available on the balance sheet. No change in the capital. So the summation of the total of the sources will be this total of the sources is 284,450, and the total of the assets will be 284,000, should be 84,000, we'll see that. Okay, 75,000, 50,000, 50,000. Okay, so the loan 154, 75,000, 50,000 minus 2,000 minus 20 plus 20, 0. The debtors investments investments have actually become 0 because we sold off the investment. The debtors 18, 15,000, cash in hand is 139, so the balance sheet tallies. So the cash in hand is 138,450, but we also want to find out the cash from operation, cash from financing, and cash from. So cash from financing, there is no inflow, but you have repaid the loan and you have paid the interest. So cash from financing is minus 21,000. Cash from investment is the sale of investment minus the purchase of computers is 105,000, and cash from operation is 150 plus 150 150 plus 22 collection minus the creditor minus Mr. X from whom we purchase the goods minus the salaries minus the tax is the cash from operation plus 54,450. Since no cash, opening cash is there, so cash in hand is 138,000, which is same as what we got here. 138,450 is the cash in hand. But our question remains that why is a profit which is 330,450 not same as 54,450, which is CFO? So let us do a reconciliation or indirect method of preparing. As we mentioned here, the profit is not same as CFO because of cash, non-cash, non-operating and working capital changes. So non-cash is depreciation on plant plus depreciation on furniture. Impairment loss is also a non-cash item. Interest is a non-operating item. Cost of investment is a non-operating item. Sale of investment is a non-operating income. Then we'll have working capital changes. We can see the debtors has decreased. That means we collected money from the debtor. Increase in the stock, that means we purchased goods on during this period, that is 50,000 minus 75,000. Decrease in creditor is that means we paid money during the period and the other creditor increased during the period, so to that extent we have not paid money, so plus 60,000 minus 50,000 because the creditors, so 0 minus 50, okay, and the outstanding salary has increased. That means we have not paid money to that extent, so it's a cash outflow or cash inflow, or in other words no cash outflow, so 54,450. So cash from operation is same whether you calculate direct or indirect. In case of a direct, we calculate and understand the cash from operations, receipts and payments, whereas in case of indirect method, we try to reconcile the profits with the adjustments, and adjustments are for non-cash, non-operating and working capital items which are there on the balance sheet and the income statement. So in this case, the non-cash items are depreciation and impairment, and non-operating items are interest and the sale of investments and the cost of investment. And the working capital changes are usual items, the changes in a debtor, the changes in a creditor, changes in a stock, and the outstanding expenses. So then we'll see the second question. The second question is, what will be the effect of this transactions on the buyback of shares? Or in other words, what will happen if the company goes for a buyback? Will that affect the cash from operation? So let us copy this information instead of disturbing that and paste here and paste here. Yes. So the additional information which is required, the rest of the things are same. The buyback statement, the buyback of share. Before we understand the buyback of share is a means of buyback of share. Buyback of shares lead to reduction of capital reduction, cash reduces. If the buyback is at a premium, the reserves will reduce, and there is a accounting adjustment, which is a new account called capital redemption reserve. Reserve is to be created to the extent of the face value of the shares bought back from the reserves. That means to the extent of the face value of the share, we transfer from the reserve to a new account called the capital redemption reserve. Let us do that. So the number of shares this company is having is 10,000. For 50,000 divided by 5, 10,000, and out of that 10% we are buying back, so 1,000 shares are bought back. The price is 30, so money payable is 30,000. The face value of the share is 5, so 55,000. So the excess money paid is the share premium. So as a result, the cash flow statement, there is a buyback of shares which is 30,000. The buyback of share is 30,000 in the cash flow statement. So as a result, the cash in hand will be 292 minus 154 minus 30. Cash changes to that extent. The capital will reduce to the extent of the face value. Reserves will reduce to the extent of the premium that you paid, the share premium 25,000, and a new account called CRR, the capital redemption reserve, is created to the extent of the face value, and that face value, that CRR, is coming from the retained profit. So the balance sheet should tally now. The retained profits have come down from the capital has come down, the reserves have come down to the extent of the share premium as well as the capital redemption reserve, and this is 37. So the balance sheet tallies. However, you observe that the CFO is not affected. The old CFO was also 54,000. Now CFO is also 54,000. The buyback is not affecting the CFO. However, buyback affects the cash from financing. So cash from financing is now the loan, interest, and buyback of share. Instead of a negative 21,000, it is negative 51,000. No change in the CFI and no change in the CFO. So therefore the changes in the capital restructuring decisions like buyback will not directly affect the cash from operations, and here we saw that cash from operation is not same as the profit because of several accounting adjustments for non-cash, non-operating and working capital.